No 25% down, no job history requirements, and infinite returns. With the strategy that we're talking about today, all of these things are possible even for beginners, so let's get started. Welcome back to the channel, guys, and yes, today we are talking about the BRRRR strategy. That is 4 R's: buy, rehab, rent, refinance, and repeat. Now, there's some debate about where this strategy came from and who invented it, but most people give Brandon Turner credit with at least coming up with the catchy acronym. And no matter who invented it, there are plenty of people taking advantage of this strategy. And if you, even as a beginner in real estate, want to achieve financial freedom, this is a strategy you have to know about. So in today's video, we're gonna break down the 5 steps of the BRRRR strategy, talk about how they piece together, and why many people say this is the #1 way to invest in real estate. And as a bonus, I'm gonna share the details of a property that I'm rehabbing right now and what the numbers might look like if I decide to flip it and just sell it when the rehab is done, or if I use the BRRRR strategy on it. All of that is coming up, so make sure that you've changed the color of the like button, as that truly is the best way to tell me and the YouTube algorithm that my channel gives out a ton of free game. So I appreciate you hitting that thumbs up button, and let's dive in. So just like wholesaling, which if you've watched my channel before is a strategy that I talk a lot about and is really good for beginners, but the BRRRR strategy starts in the exact same place, and that is finding a good deal. There are a lot of ways to define exactly what a good deal is, but it all starts with finding a property that you can purchase for below market value, and if it's below market value, that usually means it's in poor condition. Now, to buy a property that's not in the best condition, there's a couple of options. You could go to a traditional bank and get a loan for an investment property, which would usually cost you 20 to 25% down, or you could have the cash yourself, or you could go to a private or hard money lender, who is a type of private person or company that specializes in giving loans to investors for the purpose of rehabbing distressed properties. So let's say you come across a property that looks like this, and you can get it for $100,000. So you can put down $20,000 to $25,000 and get a loan from a bank. Or with the BRRRR strategy, the 2 options you're going to want to focus on is either buying that property for cash, if you've got $100K sitting around, or using a private or hard money loan. And there are a lot of hard money lenders out there that will fund 90 to even 100% of the money you need to get your deals done. We'll talk more about hard money lenders later in the video. So wherever you get the money, that covers the B in the BRRRR strategy, the buy. And the first R stands for rehab. You now own the property, but it is in desperate need of a facelift. And so let's imagine you put $30,000 into renovating this property. Again, that can either be your cash or the hard money lenders. And of course, the hard money lender will charge you interest, but we will talk about that in a moment. Once the rehab is done, this is where most investors who are not using the BRRRR strategy would sell it and list it on a site like Zillow or Redfin and take the highest bidder. If you've ever watched Chip and Joanna Gaines on HGTV, you know exactly what I'm talking about. So in our example, we purchased for $100,000, we put $30,000 into the rehab, so we're all in for $130,000. Let's imagine we could sell for $175,000. After paying back our hard money lender for the money they lent us, as well as our fees and closing costs, we might make $35,000 on this deal. And that could be a really nice payday, especially if the rehab only took a month or 2. But people who like the BRRRR strategy would say that making that $35,000 is a mistake. There are a few reasons for this, so let's dive into a few. The first is that flipping houses is active income, not passive income. Whether you're actually out there swinging the hammer and painting the house yourself, or maybe you're gonna hire a project manager, you still have to actively be involved until you get like a huge company and you can hire someone to manage the entire thing for you. But for most people, flipping houses is very, very active income. It's not a job where you're just gonna go live on the beach and disconnect from society anytime soon. It's also active in the sense that when you're flipping houses, you are dependent on continuously buying and rehabbing properties. Sure, you might make $35,000 on this deal, but if you just stop, your income immediately goes to 0. You've got to continuously have properties going through your system of buying, rehabbing, and selling if you want to continuously make money. The other downside to flipping being active income is that the IRS looks at it in the same way. And active income in the eyes of the IRS, or in this case, what is called capital gains, is one of the types of incomes that is taxed the most, much more than passive income like you would have cash flow from a rental property. That's taxed at a much lower level. So of course, I'm not a tax advisor, but you can imagine that that $35,000 of profit is probably going to be cut in half or 40% by your taxes. And so the payday is looking a lot smaller at that point. On the flip side, pun intended, after buying and rehabbing a house, people who are using the BRRRR strategy would not list it for sale. They would instead list it for rent. This addresses both of the downsides we talked about having active income. Let's imagine that the property could rent out for about $1,200 a month. That income, while it's much less than 35 grand, is also much more passive. But even if you had the cash to go all in to spend $130,000, you would still have to pay property taxes. So that would take a little bit from your income. But even just spending $130,000 to make $1,200 a month is not the best return on investment. And having $130,000 up front is not that realistic for most people. So that's why a lot of people using the BRRRR strategy get their money from hard money lenders. Hard money loans are not like bank loans. They are usually a private individual or company who is focused on giving loans, most times 80, 90, 100% of the amount needed to investors for them to rehab properties. They're short-term loans with higher interest, whereas bank loans are really hard to get on distressed properties without you putting down a huge down payment at the beginning. So that's why people like hard money loans, but nothing is free. And hard money lenders usually charge 8 to 12% interest as well as other fees for them to loan you that money. And these loans are usually short-term loans, meaning in 3, 6, or 12 months, whatever you and the hard money lender agree on, that's when you have to pay back the entire amount of what you borrowed from them. That's why the BRRRR strategy doesn't stop after you buy, rehab, and rent out the property, because time is ticking where you've got to pay off that hard money loan, and that $1,200 a month is not going to cut it. That's why the next R is refinance. So you can get out of that expensive short-term hard money loan and get into a lower interest, longer-term bank loan. Let's say that the hard money lender gave you the entire $130,000 that you needed for this project. And by the way, if you think that's unrealistic or you want to find a hard money lender to fund your deals in this way, definitely make sure you have notifications on, because I'm going to be making a video shortly about how I met my hard money lender and how you can negotiate terms to try to get them to give you up to that 100% of the money that you need. So turn on notifications so you don't miss that video. But $130,000 from the hard money lender, and let's say that's at 10% interest. That's $13,000 a year paid monthly, because remember, hard money loans can be 3 months, 6 months, or 12 months. So you'd owe about just over $1,000 a month to that hard money lender for the length of your loan. That $1,000 or so might not be a bad expense when you're rehabbing the property in the first few months when you have the renter in there, but eventually you're gonna owe that $130,000 back, and that's why you have to go to the bank and do something called a cash out refinance. Most people go to the bank first for their first time financing the project, and they get a loan at the very beginning, and then they over time pay down that loan. But this is called a refinance because the first financing was either with our own cash or from the hard money loan, and now we're going to do something called a cash out refinance to kind of have that loan from the bank pay off our original financing. But in our case, we've got the first set of financing is the cash that we put into the deal or the loan from our hard money lender, and we're going to refinance and instead use a bank loan on the property. This type of cash out refinance is meant to help you take equity out of your home in the form of cash. So here's how the numbers might work for our example. We bought and renovated a property for $130,000, and we could sell it for $175,000, but we decide not to. Instead, we go to the bank and we ask for this cash out refinance. The bank will send out an appraiser to the property to determine how much the property is worth now that you've fixed it up. And let's say in this example, they agree that it's worth $175,000. Most banks will give you about 80% of that amount as cash for your cash out refinance. So $175,000 times 80% is $140,000. So the bank will give you a cash loan of $140,000 as a mortgage on this property to be paid back over, let's say, 30 years. That $140,000 in cash lets you pay off the $130,000 you borrowed from the hard money lender. So that loan is done. Then you've got about $10,000 left over, and closing costs on a cash out refinance are usually 2 to 5%. So 5% times that $140,000 that you're getting a loan for is around $7,000. So in this example, you could theoretically have about $3,000 actually paid to you at closing. Now, $3,000 versus $35,000 seems like a huge difference, but the big benefit of doing the BRRRR strategy is that we now own a fully renovated, cash flowing rental property, and we might have gotten paid a couple of bucks at closing as well. Instead of that high interest, short-term hard money loan, we've paid that loan off and replaced it with a long-term, low interest bank loan. Well, right now, at the time that I'm recording this video, the average interest rate for most 30-year bank loans is right around 3.03%, much cheaper than that short-term hard money loan. At 3.03% interest for 30 years, we'd owe just about $850 a month, depending what state you're in for property taxes and what your homeowner's insurance costs. And with that $1,200 of rent coming in, we could easily set aside $200 a month for repairs and vacancy and still be cash flowing $150 a month passively while building equity as our property appreciates over time. Plus, the fact that you just finished rehabbing this property means that your repair and maintenance cost is probably going to be pretty low because your property is in basically brand new condition. The passive income that you get from having a rental property builds up over time and as you add more of these properties to your portfolio, which is why a lot of people say that the BRRRR strategy is the best strategy out there for truly achieving financial freedom and not just having a high-paying house flipping job. And it's not just about buying rentals versus buying properties to flip. It's the way you go about doing the financing. Because the traditional way of buying rental properties is to go to the bank, get a loan at the beginning of the process, and pay 20 or 25% down. Whether you've got that cash or not, you pretty much have to have that cash yourself. There's no getting a hard money loan to make your down payment. So you've got to have, in our example, for that $100,000 purchase, 25 grand. Then if you've got another 30 grand to do the rehab, you've got to put that in as well. And after the fact, of course, you can still rent out that property, but with this traditional method, there's no refinancing to get that cash back out so that you can do the last R in the BRRRR strategy, which is repeat and use it again for your next deal. With the BRRRR strategy, you paid back your hard money lender, you've got back any money that you possibly put in, and you're ready to go again. And if you did it all right, you also have a cash flowing rental property that's making you infinite return because you don't have any money left in the deal. Everything you make is just cake, icing. What is the phrase? I don't know. Hopefully that explanation helps the BRRRR strategy make sense, but this is by no means a foolproof strategy. You've got to make sure you're buying at the right price. You've got to accurately estimate and then execute a rehab project, and then you have to make sure that the property appraises for what you thought it was going to appraise for, because if that 80% of whatever the appraiser says the property is worth is not enough to pay back your hard money loan, you're in big trouble. I've basically spent the last 3 years learning about real estate, house hacking, and wholesaling so that I can feel comfortable enough taking out a loan and being confident that I'll be able to pay it back with my cash out refinance. So let's apply this BRRRR strategy that we talked about to a real life deal that I'm rehabbing right now. And you can tell me whether you think I should just go ahead and flip it and sell it when I'm done and take the lump sum of cash, or if I should attempt to BRRRR it. So the purchase price for this house is $106,000. The rehab budget is $25,000. So that puts us all in at needing $131,000. Then we're gonna add on $2,000 for holding costs and closing costs. That puts us all in at $133,000. I'm working with a local hard money lender for this deal. They'll lend me about $90,000, which means that I need to use income from house hacking, savings, and most recently, wholesaling to come up with $43,000 to complete the purchase and the rehab. As a side note, this is why I think wholesaling is one of the best ways to get started investing in real estate, because it's a very low risk way. It's not easy, you gotta work at it, but it's a very low risk way to get the capital you need to start putting into your own deals. If you watch this video right here, you'll see me break down all of the numbers on these average hard money loans, fees, interest, all of that stuff, and how that gets paid back. So we're all in for $133,000. And when Rehab, this property can rent out for about $11.50 a month. And hopefully, when the rehab is done, will appraise for about $170,000, $175,000. So taking 80% of that $175,000 puts us at $140,000, which is what the bank will give me for a cash out refinance. That $140,000 is definitely enough to pay back my $90,000 hard money loan. And this is one of the reasons that you might not want to use 100% of the hard money lender's cash, because it really brings your margin of error very close to each other. So if I was using all $133,000 from the hard money lender and I thought I was going to be able to get $140,000 out, I've only got $7,000 of wiggle room, versus I'm only using $90K of their money and I'm expecting to get $140K. Now I've got $50,000 of wiggle room where I know I'm going to be able to pay this loan back, even if I get a little bit low of an appraisal, which will bring me in a little bit under that $140,000. So I can pay off the $90K from the hard money lender, and if I get that $140,000 like I'm expecting, I'll also be able to pay back myself for the $43,000 that I put in. That will leave me with about $7,000 left over, most of which would likely go to my closing costs for the cash out refinance. So it's possible that this could be a perfect BRRRR deal where all of the money that you put in, you get out, and maybe you don't make anything, but you've broken even and you still have a cash flowing rental that's generating you passive income every month. And because you paid back your hard money lender according to their terms, you're much more likely to be able to work with them in the future for your next deal, so that you can just repeat and kind of just keep using the same money over and over, put it into a deal, take it out, keep that property, put it into a deal, take it out, keep that property. And that's how people build up their rental portfolios so quickly, because they don't have to keep putting 20% into one deal and leaving that 20% in the deal and then saving up or earning enough to put another 20% in the next one. You're pretty much using the same dollar over and over again. But one more thing to consider is that the more money you take out for the cash out refinance, the smaller your cash flow every month is going to be. So if I want to take out the full 80%, I'd be taking out $140,000, and I'd have to pay about $850 a month to pay that loan back. But let's say instead I tell the lender that I don't want to take out 80%, I want to take out 75%. So that would get me $131,250, which is still more than enough to pay off my $90,000 hard money loan, and I'd actually pay back myself most of that $43,000 that I put into the deal, and then I would just have to come out of pocket to pay my closing costs, which let's say are $7,000. This might seem like a bad deal because I'm leaving money in the deal. I've actually got to pay something to get this deal done. But $7,000, $8,000 left in the deal to have my monthly payment lowered because I'm borrowing less money, so now my monthly payment would only be around $800, is increasing my cash flow every month. So there is a balance to be had, and this is where I say you've got to keep in mind the real estate fundamentals and what your particular goals are. If you need the cash to do another deal or to purchase something, then maybe it's a good idea to get out as much as you can. But if your focus is to build wealth through passive income, then maybe you don't want to take all of the money out of the deal, because that will lower your monthly payment and increase your cash flow every month. If you want to learn more about these investing fundamentals, I have linked all of my book suggestions that you should read no matter what strategy you want to use, and I will specifically link the BRRRR book that I read that was just amazing in breaking down all these little nuances for you. Those will all be linked in the description. So in the meantime, let me know what you would do with this deal. Would you flip it and sell it and take your $25,000, $30,000 lump sum payment, or would you try to BRRRR it? If you do BRRRR it, would you leave some money in the deal to lower your monthly payment, or would you get as much cash out of it as possible? These are all great thought experiments for us to do and to continue learning. So I'm looking forward to reading your comments, and until next time, thanks for watching.